Welcome to the Green Team Speaks To, the podcast for the Paulson Institute's Green Finance Center. I'm Deborah Lehr, Vice Chairman and Executive Director of the Paulson Institute. Today, I'm speaking with Vikram Widge, Senior Advisor at the Climate Policy Initiative, who has extensive knowledge on green finance, having previously served as the Global Head of Climate Finance and Policy at the International Finance Corporation. Vikram, welcome to the Green Team Speaks To podcast. It's really a pleasure to have you on, and we appreciate that you've made time to join us today. You are a giant in the field of sustainable finance, having been part of some of the early innovative thinking and doing in the field, from financing cook stoves to developing forest bonds. I'm looking forward to our conversation today, drawing upon your deep expertise. Tell us, to get started, about the Climate Policy Initiative. We're very impressed with their mission to provide finance and economic growth in a sustainable manner, which aligns very much with that of the Paulson Institute.
Thank you so much, Deborah, and thank you for that very gracious and generous introduction. It is indeed a pleasure to be here and to be speaking with you about all things of so much importance to us. I joined CPI, the Climate Policy Initiative, about 15 months ago after a long stint at IFC. And CPI is an analysis and advisory organization that has deep expertise in finance and policy. So post IFC, it seemed like a good fit. It is non-profit and non-partisan. And like you said, with CPI's mission in terms of helping governments, businesses, and financial institutions so that they can drive economic growth while addressing climate change, right? So our vision at CPI is to help build a sustainable, resilient, inclusive global economy that dovetails well with, as you already mentioned, a lot of what the Paulson Institute is trying to do as well.
It does. And so earlier this year, the CPI released a report about scaling climate finance, focused particularly on China. Can you tell us about some of the key findings from the report and what you're seeing in terms of developments since it's been published?
Yeah, so just for some context, which obviously is familiar to you, since China first introduced the green financial reform in 2015, I guess it was, and actually some colleagues, not me directly, but other colleagues at IFC were quite engaged on that. And it's made a lot of progress, right? I mean, the key factors have included the fact that there's been high-level political buy-in. The central bank has shown tremendous leadership. There's been huge progress in developing green taxonomies, the focus in pilot zones, as well as a lot of incentives that have been provided to different segments of the economy, all of which have contributed to the success. And in our sort of evaluation and the collation of data, in just a few years, the green finance in China has sort of crossed the $300 billion mark, which makes China one of the largest contributors of green finance globally in terms of the whole landscape of climate finance that CPI also does. But what we found was that the next decade in climate-related investment is going to need to increase by 4 times. I think the Paulson Institute's own estimate sort of says $1 trillion a year. And even the Tsinghua University study said over 20 trillion, I think 21 trillion needed in the next 30 years. So this is ambitious. But the CPI report concluded that this is achievable. There is a potential for significant positive returns on other fronts also, including trade competitiveness, job growth, supply chain resilience, which thanks to COVID, we all have to come to grips with and realize how sensitive that is, but also, of course, overall economic stability. So, China does have a huge potential to expand climate finance because the current penetration, or quote unquote green penetration, in China's financial system is only about 4%. So there is ample room for growth. There has been increasing financial support for SMEs. There are new sources of concessional capital being made available, and there is growing interest in how to explore, expand, and implement new innovative structures. There are growing opportunities for foreign private capital to collaborate with domestic actors. through funds, JVs, as well as, of course, greening the investment opportunities in the Belt and Road countries, right? The conclusion really was that to take advantage of these opportunities, China is going to have to address some key barriers. While the top-down approach to implementing green finance has led to, mobilization of large pools of capital, it's still concentrated amongst government and state-owned actors. So is there, some diversification of capital to more commercial players, the private sector, clearer policy signals and incentives, participation, and I already said financing, broader base, and then, of course, a robust framework for accountability. So I think that is what I would say is where the report came out. As far as developments since the report was published that you asked about, the 14th five-year plan was not as ambitious as many had hoped for, at least. So we think, right, there are no absolute targets for energy use and carbon emissions, and the target for non-fossil fuel power generation also remains modest. But more importantly, I think more ambitious, or even more important than the net zero target for 2060, shorter term targets for 2025 and 2030 are probably, I think we are collectively all saying everybody should be doing it. So China is no exception. It's not just the goal, it's how you get to the goal, the pathway, right? But, in spite of that, it is our understanding that many local governments have got the message on what will inevitably be a pathway to achieving these goals, and are all trying to figure out how to become carbon neutral.
Yeah, I mean, you've covered a lot, both in the report and the developments. And certainly, as they always say, where there's a problem, there's an opportunity. And with the news that China's carbon emissions are larger than the rest of the world combined, you're giving us some hope that there are solutions. And it's encouraging that it can be done through the markets as well. Certainly, we've seen a more concerted push for action in China following the commitment by President Xi to reach carbon neutrality in 2060. And one of the main mechanisms that China is looking to reach that goal is through creating what we hope will be an effective and efficient national carbon market. There's lots of big ideas in climate, but often not ones that come to fruition. Hopefully, the launch of this carbon exchange, which is supposed to be effective next month in June, will be one of these big ideas, because just starting with one industry, with the power industry, it will automatically be the largest carbon exchange in the world. But I think more important, it will bring 14% of global emissions under trading by the fact that China's power industry is so large. What are your expectations for the national carbon market, and what do you see as the challenges that China's facing in making this an efficient market?
Let me start by saying that the power sector is certainly the right sector to start with. You already mentioned the magnitude of both its size and its impact on global emissions. And hopefully the market and the exchange will in fact launch next month, as you say. And it's, from what I understand, it's over 2,000 firms that are going to be covered. So it's pretty impressive in its own right. But the history is such that I think our sense is that people on the ground seem to have mixed feelings about, will it really launch? And it's a month away, so we'll find out soon enough. And how effective will it be, really, right? It hasn't been an important driver of change yet. Some of the engagement, especially through the work jointly we were doing with the World Bank, goes back several years. You're well familiar, everybody's familiar with the provincial pilots. Progress kept getting stalled. Prices were too low to make any meaningful impact. And I think that is where some of the challenges may be, or some of the opportunities may be, right? I mean, if we can overcome the challenges in politics that ultimately seem to have been overcome because China is about to launch a national scheme, it will come down to what is likely to be the price of the traded emissions or emission reductions, or whatever the currency is going to be ultimately called, and what impact it actually is going to happen in terms of transitioning away from fossil fuels. We've all familiar with the fact that the call is for $40 to $80 per ton in terms of carbon pricing for the near term in this decade in order for it to be truly effective. And that is challenging. There's nobody, I think, even the most recent World Bank report, they, I think, published their state and trends of carbon pricing, I think it's called now, and no longer carbon markets. And nobody is anywhere close to that. So can China ultimately manage to make this efficient and effective? I really hope so. Beyond that, I think, given where the IEA is, given where the most recent report on fossil fuels, or the elimination of that, and how that will ultimately get effected, if you will, through this mechanism. So I have hopes for it, but a lot is going to ultimately, I think, depend on how the cap and trade part of the system really works to drive prices and create the incentives for that transition.
Yeah, you hit upon some of the key points, and these are concerns that we share as well. I mean, I think it's important to all of us that China get it right. And that's one of the reasons that I wanted to emphasize that not only is it important because it covers about 45% of China's own emissions, but the fact that it brings 14% of global emissions means that all the world should be supportive of China getting it right.
And that's going to be critical, right? Not only just as an example, but in a near future world where all of these hopefully find a way of linking to each other, it's all going to become a critical driver for a lot of other parts of the world economy as well. So much like you said already.
Yes, exactly. And at times when many of these governments themselves are struggling with coming out of the post-COVID recession, looking at can they use sort of sustainable finance as a means, as you pointed out, of generating economic growth and jobs, but also recognizing that with many of the ambitious goals that they have for green finance, public funds are not going to cover them. In most cases, even in a case with China, where they do have significant government funds, it's only going to provide maybe up to 10 to 15% of the financing, and the rest has to come from the private sector. So these kinds of mechanisms, I think that you have been working on and tested out in the International Finance Corporation context and World Bank context, become increasingly important in creating, right, the structure to attract public financing. What do you see as some of the key issues for attracting this private sector money, and what should the role of these multinational institutions be in helping with that process?
Right. So, much like we were talking about in terms of pricing carbon, I think the public sector, both the regulatory and the government aspect of it and the public finance aspect, it are critical ultimately to both mobilize, and of course the MDBs play a role, and we'll talk about that in a minute. But just in terms of the public context, I wanted to just underscore the fact that pricing carbon, fossil fuel subsidy reform, as well as, of course, green budgeting are all important elements of any sort of government sort of policy toolkit, to say the least, right? And the hope is that the massive amounts of post-COVID recovery stimulus is actually going to be used. It's a perfect opportunity to put some of these policies in place. Public finance is going to remain essential, but as you said, it's limited. And so maybe we need to reserve its use for more catalytic impact, right? CPI did a sort of separate study in the Asian context and found that the majority of actually COVID stimulus packages are providing tax cuts and bailouts to polluting industries, coal mining, coal-based electricity. So hopefully the next push is going to address that, and the green bits are going to be the majority of how it is going to be deployed, because otherwise, not only do you have these public investments at the risk of being stranded, the appetite for foreign investment diminishes. There are longer term negative impacts, as we know, fossil fuel use, such as dangerous local air pollution, right? I mean, countries like China, countries like India are already suffering from those impacts. So there are a lot of sort of co-benefits, of course, of being able to do that. So as long as sort of consistent and clear policy raises the ambition, creates more incentives so that there is support to experiment with the innovative financing structures that I was talking about earlier, and then helping sort of build and increase the visibility of the pipeline of green projects that private actors can be part of or run with on their own. And I think since we're talking about China, it's worth highlighting some of the kind of matchmaking platforms like I think the Bank of Huzhou, I'm probably not pronouncing that correctly, but they have a green credit management platform. The municipal government there has a green finance sort of one-stop service window. And so all of these can, if you can expand on these and replicate them, they can reduce the search costs for the investors, right? And they can increase the efficiency by matchmaking. In fact, CPI is considering launching a broader sort of Asia-Pacific adjunct to its own reasonably successful global innovation lab for climate finance that will help hopefully surface some of these new innovative business models, and as well as replicate those that have already been incubated by the lab. And hopefully these are both attractive to Chinese investors inside and outside China. But then, of course, the private actors themselves need to get into the act, right? I mean, yes, all this is good, but we can't just keep waiting for public policy to get into place. And our hope is that the private actors will start to sort of coalesce around this whole thing, that the post-pandemic recovery provides an opportunity to actually do a step shift in what this whole pathway to net zero is going to look like. Again, not to sort of, it just happens to be a lot of relevant work recently, but in collaboration with Oxford University and the European Climate Foundation, CPI recently produced, and it was the framework for sustainable finance integrity, right? And it's asking for different private sector actors in the financial community, whether you're a bank or an insurance company or an asset owner or manager, that you set these clear targets and objectives, right? I mean, you commit to align yourself with the Paris Agreement, you mainstream sustainability into operations, and you establish and report on metrics. The interesting thing about all this, of course, is that having done sort of the first TCFD disclosure for MDB while in sort of my last year or two at IFC, this actually surfaces not only the gaps and the actions you need, but also the opportunities where you actually should be focused on for investing into the future. And I think that's critical for private capital to sort of be looking at as well. I've gone on long enough, but if you want, we can talk a little bit about MDBs as well.
Yeah, I think it's helpful to understand what the roles are of MDBs in green finance.
Great. So I think, as with the other actors, MDBs also need to set a sort of net zero and sustainability target for themselves, right? We mainstream these into their own operations and start the reporting, much consistent with the framework I just talked about, right? But beyond this, I think they can lead by example, set ambitious sort of sustainable climate finance commitments, as well as fairly ambitious private capital mobilization targets. How else are we going to get to trillions of dollars? Because the MDBs themselves don't have that kind of money. And this sort of links back to, of course, their public masters and their own sort of investors, core investment that comes from governments. But in terms of how that can do, at the end of the day, they will have to also look at doing certain basic things. Do they have near-term fossil fuel finance phase-out plans, right? Leading example is the EIB, the European Investment Bank, that has already totally announced that it will align with the Paris Agreement. It already probably has, because I think their date was 2020. The World Bank Group has announced that it will be aligned sometime between 2025 and 2030 in terms of that. So these are important announcements. The commitments that will follow, the plans that will actually see this implemented are, of course, going to be key. And I think some of the MDBs could think more originally and creatively in terms of how to unlock the much sought after institutional investors who sort of are the pool of global savings that they control. We all talk about there being enough money, but not enough projects. But honestly, a lot of this money remains locked because it tends to be sort of risk averse, scale averse. By that I mean sort of it needs to be large investments. It needs to be sufficiently risk adjusted in a way that is comfortable, and it needs to not be super complicated.
Mm-hmm.
And in that context, unless we can figure out how to service that set of requirements, I think it's going to be extremely challenging to unlock this global pool that everybody says is available, and we should be, especially if you're going to deploy it in emerging markets. It's not going to be that straightforward, and I think the MDBs have a critical role in getting creative and trying to help unlock some of that by addressing some of these concerns, by aggregating, perhaps by de-risking, and then creating products around that.
And they do play a really important role. And we see growing political will when it comes to green finance. You know, one of the positive signs that we've seen recently is the re-establishment of the G20 Sustainable Finance Working Group, and the fact that the United States and China are now the co-chairs, and that this is back high on the agenda for the G20 is very encouraging. And we see that climate finance is also high on the agenda at the G7, of the COP26. And so what are your expectations as you talk about targets for the multinationals? But I think it's important that the leaders come out with very strong statements on green finance to send signals to the financial markets and to the other quasi-government institutions that this is important, an important part of recovery. Do you have a sense of what some of those outcomes might be, or what you would like to see coming out of these bodies?
Right. Look, the momentum after all these years of gnashing our teeth is very welcome. Hopefully will make up for at least what I think are where we should have been about at least 10 years ago, if not 20 years ago. But it's still very hard to predict outcomes because so much is already starting to happen across the whole ecosystem, right? I mean, the governments, in the private sector, publics, the broader public realm as well. So from where I hope we will actually end up focusing on, or at least the discussion in these fora will focus on, is one, on targets. I think hopefully there'll be debate and there'll be a refinement of these targets. Everybody is getting increasingly comfortable with announcing a net zero by 2050 type sort of headline, 2060 in China's case. But as I mentioned earlier, I mean, these are susceptible to at least accusations of greenwashing ultimately. And this is true for private, the corporate, and the financial sector as well. But acknowledging that we've come a long way in a very short period of time, we need to make sure that these are credible, right? I mean, it's not only the target, but it's also the pathway to those targets. And I think that is critical for green finance, because once those pathways, sort of interim targets, if you will, get established, then there will be a bigger push for sort of the transition commitments made by all actors, and the debate on sort of portfolio alignment, while will continue, will hopefully become more operational, will sort of have more operational issues than the discussion on how, where, when. So that will, I hope, create the specificity that we actually need for the next 30 odd years in terms of trying to do that. Carbon pricing and carbon markets we already talked about. That, I think, remains critical in terms of trying to figure out. Hopefully the overdue discussion on establishing the so-called Article 6 rulebook for compliance markets will happen, at least by or at COP26. And of course, the voluntary carbon market, right? I mean, which is now a topic of discussion and much progress thanks to Mark Carney's task force, is going to be important, right? But the debate on usability and the quality of who can use the offsets, when can they use them, what is the quality of the offsets that they should use, are robustly underway. And that's actually quite good, because then we can hopefully coalesce around a set of guide rails, standards, thresholds, whatever phrase we want to use for that, and then make meaningful progress, right? Which is going to be critical in terms of enhancing the ambition and the needed financial flows, which I'm hoping, if governments can provide the policy framework, the support, take their own actions. It was very welcome to see the G7 communique, talk about ending financing overseas of fossil fuels. That's great, but will that seep into sort of the broader G20 agenda? Will there be action? There's already been enough discussion in fossil fuel subsidies. Will they increase penalties for high emissions activities? Will they provide incentives for transition activities? There's a lot in the both sort of the regulatory and tax system that can be done to catalyze multiples more of private investment, right? So I'm hoping that they will do that. There's also the issue of debt relief and debt management, which of course has become fairly critical in the post-COVID era. And I think there's an opportunity for the larger economies of the world to help support in the process this whole transition to sort of green and ultimately sort of low carbon net zero world, whether it's sort of the debt service and suspension initiative championed by IMF or World Bank, or the debt for climate swaps. That could also be an important vehicle. It's a bit of a topic du jour. We also recently released a discussion paper on that, but probably a topic for another day. So hopefully we can sort of use this opportunity to sort of say, okay, net zero is our end goal, but what do we actually achieve in the process, right? I mean, do we get to a true sort of a sustainable society? Can we address our safety nets in the process, whether they be in terms of income, whether in terms of healthcare? Can we use this opportunity to address air pollution that I mentioned earlier? It's deadly in terms of, and that should be of interest, if not in the global interest, absolutely in the local interest to do that. And all of these things align so well with just trying to address climate. Holistic inclusion of SDGs is great, but a lot of them are interconnected. And so I think it's a great opportunity. And hopefully all of this will come to actually measuring and reporting on what they are doing in terms of their targets, in terms of financing those targets, and ultimately telling the world how much of that they actually managed to do.
Yeah, well, you've covered a lot in that. I have just one follow-up question I'd like to ask. You touched upon the issue of debt, and it's very understandable during this time that governments have been issuing a lot of debt. But more and more in the discussions that we're having around the world, there's a focus that there's plenty of green debt out there now, and what we need is more green equity. And it's been interesting with what we've seen in the private sector, the rise of more and more PE funds who are now looking for clean tech opportunities and clean tech solutions. Do you see this as one of the next big trends?
So look, I mean, okay, this is only a half throwaway remark, but if you invested in Tesla even a year or two ago, you made out like a bandit.
Exactly.
But we also know that for every Tesla, there are dozens of investments that are not anywhere close to being that successful, right? But that's what private equity does well, right? I mean, it takes an approach, it hits a few out of the ballpark, and everybody ultimately benefits, and hopefully the private equity funds make enough money to keep going. A lot of this sort of discussion has been going on and off. I mean, the whole focus on green bonds for a while was, some people argued, overstated, because the issue was there was not enough equity, which is the true funds at risk. And we're going to ultimately need a lot more of that. It'll help in many ways, right? Of course, it'll help in advancement of new technologies. That's the clean tech aspect. And we need some, or let's put it this way, we need many more if you're going to ultimately convincingly make headway on the net zero commitments. But at the same time, my concern remains in terms of deploying this in emerging markets, right? So how do we ultimately help open up these markets for green equity, as you said, in the markets beyond the established few? Ultimately, if that's where the action is going to be, if that's where a lot of the debt is going to get deployed, we need to be looking ahead to help those markets develop, the equity markets and most of the emerging markets develop in a way that allows for a lot more of this to happen, both locally, but also in terms of foreign inflows. And of course, ahead of that, there has to be an even bigger surge in what the established financial centers are already being able to do. But this will have to happen fairly quickly. So yes, the short answer is there is huge opportunity for sure. But as of now, what I'm observing and seeing is that it's still happening in relatively smaller amounts. And if this is going to become better than an alternative investment type asset class for the large institutional investors, then we're going to have to see more successes, more robustness, and more sort of formation around it.
Well, we've covered a lot of territory in this discussion. So I'd like to move from the big picture to the small picture and focus on you. And hopefully this is an easy question to close, just to touch upon what are some of the ways that you live a green or sustainable lifestyle?
Yeah, okay, that's good. So actually, just linking back to the whole issue of targets and measuring and reporting, a small group of us did a personal carbon footprint exercise during my last year at IFC to help us figure it out and to see where we were, what we could do, and what commitments we were making and trying to accomplish. So for me, I already purchase wind generated electricity and pay the provider extra to offset the natural gas that is what is used for heating and cooking in my 80-year-old house. So it's maybe when I change homes, we can look more into that. But for now, that is sort of at least offset. It's carbon neutral, if not zero. I do have a car, but after 7 years of owning it, it barely has 20,000 miles. So I pretty much walk or take public transport or shared rides to the extent possible. I live in the city, so that's easier. I have been trying somewhat successfully, or you could say somewhat unsuccessfully, it's halfway there, to reduce my red meat consumption and trying to limit it to no more than a couple of times. Although I'm an avid reader of all the discussions that tell us that maybe we all agree that that needs to reduce. Does it need to go to zero? I don't want to get into that debate, but at least I'm definitely trying to reduce it. My biggest footprint comes from flying for personal reasons, honestly, because it's not just leisure travel that COVID's curtailed for all of us anyway, but just to spend time with aging, ailing parents who lives in India. So that long haul flying, can't do much about that. Offset it and try, but it's a challenge, and I sort of, with that, empathize with everybody struggling with trying to say, we're going to get to net zero, but how are we going to get to that? There have to be viable options and alternatives available as much at the personal level as sort of the broader sort of corporate financial sector level, right?
It is. As a frequent flyer, I'm sympathetic about that also, and how we support viable options. I mean, it's not possible, for example, to take a train to China. So how do we find other ways? Other ways
well,
to
the
get there?
technology is not here yet to risk ourselves on an electric aircraft yet. It doesn't have the range to start with, but yes. So we're all in it, from personal to work to everything else that we are trying to do. But hopefully, collectively, we shall overcome and succeed.
That's right. Well, that's a great note and positive note to end on. Vikram, thank you so much for sharing your thoughts with us. These are such important topics, and you have such deep background and experience. We're really appreciative of your insights. Thank you.
Thank you so much, Deborah, and thank you. And appreciate you and the Paulson Institute actually giving me this opportunity. It's been wonderful. Thank you again.
Thank you for joining us on Green Team Speaks To. To listen to more episodes and learn more about the Paulson Institute's work in green finance, please visit us at paulsoninstitute.org. See you next time.